Our next guest says that he is focused on three key trends right now: market momentum, AI growth, and rising inflation. Joining us right now is Rowe Price's head of global multi-asset and chief investment officer, Sebastien Page. Sebastien, let's talk about this right now. Again, $1.8 trillion in assets under management. Obviously, AI growth is the biggie, but today we are seeing a pullback in technology with the NASDAQ indicated off by about 480 points. Describe your conviction with AI and whether you think it will continue to fuel the markets.
Thank you, Becky. Strong conviction on the AI theme overall, especially for the next 6 to 12 months. You're right that the peak momentum stocks have come down quite a bit over the last 4 weeks. But the interesting part for us, for portfolio managers, for stock analysts, is these rotating bottlenecks in the supply chain feeding the AI theme. What I care about when I look at the CapEx cycle, which is for AI, capital spending expected to be still $3 trillion over the next 3 years. Will this continue? Are these estimates reasonable? I think they are, because there's tremendous demand for the end product. ChatGPT's at 1 billion users. The demand for Claude and other applications in enterprises, including our own, is almost going vertical right now. People love the end product, and we're scratching the surface on the benefits that the adopters are going to get. But you have rotations. You have peak momentum stocks coming down about 20% over the last 4 weeks. But meanwhile, for skilled analysts and stock pickers, it's super exciting, because you see where the bottlenecks are rolling into, whether it's cooling equipment, back-end equipment, process controls, companies that put chips together into a single component. There's a lot of research and opportunities around the theme. So in short, Becky, still quite positive on the theme, but you have to follow the bottlenecks and ultimately think about how the adopters are going to benefit from this. We're only scratching the surface in terms of margin benefits and cost cutting for the adopters.
Rising inflation is another theme, and we just talked about that with Steve Leisman. In his poll, it showed that cost of food popped up in every demographic. Cost of housing popped up for younger demographics as well. How do you combine that with what you're seeing with this excitement in AI?
You know, those themes are typically treated separately in market commentary, but there's probably a convergence because, you know, the costs are rising. That's part of what I call the bottlenecks. But also AI can become almost a source of inflation because of the tremendous energy demand and activity it generates on the industrial side. What's interesting, Becky, and I will say right away, we are still worried about inflation, especially compared to how the market seems to be pricing the risk. A swap contract, where traders exchange contracts based on 1 year ahead inflation forecast, is showing 2% or even below 2% for the next 12 months. And we're running at 3.5%. Yay, we had a soft print last month, but we're running at 3.5% CPI. So we think the market might be underpricing this risk. We are hedging it. I loved your discussion with Steve Leisman. There are lagged effects. Like food could get even more expensive because of fertilizer cost. And the way inflation works is it's pretty lagged. Yeah, and you know, the fact that freight costs go way up, this makes its way into the industrial supply chain, and it puts inflation pressures over several months following the peak in freight costs. And I always talk about energy because economists like to separate the energy, and Steve Leisman was talking about, yeah, gas prices up, down, people feel good, bad. But energy is required for everything, for goods and services. So there's a lagged effect between peaks in energy prices and subsequent inflation. We think it's a risk. We're hedging it in our portfolios. We're long metals stocks, mining stocks, tips, cash. And also, we're mindful that treasury bonds, when you get an inflation shock, we all know this, are not the perfect hedge in your portfolio. So we're also adding direct hedged equity strategies. It's a risk we're managing. But it's not high enough that we think the Fed will have to go,
that was
way
going to be my
aggressive
question.
and that markets will crash.
So, right. I mean, Kevin Warsh has this idea that the AI will eventually bring inflation down because it's going to boost productivity to a huge extent. That could be the long-term picture for sure. But you pointed to some of the short-term issues with AI, where it increases the cost of power, increases construction prices because the data centers that are being built. And I guess that would be the big issue. You don't think the Federal Reserve will have to step in and really raise rates aggressively in the short term until they can get to that productivity boom that he's waiting for?
Yeah, I don't think so for the next 6 months. Our economists are looking basically at no action. So I think we're okay. The short-term rate has already come down by 175 basis points from peak. And you have to look at financial conditions overall. What's happening to the longer-end rates? And those have risen a little bit, and that tightens financial conditions a little bit, and that actually helps the Fed with the job. So I'm not too worried about it. We are, however, short duration, right? We prefer to have a little bit more cash than longer-term bonds because of overall pressure, positive pressures on rates. But, Becky, more of a, steepening, more of the longer-end rates continuing to go up a little bit. And that's a risk that's easy to control from a portfolio perspective.